The introduction of IFRS 15, revenue from contracts with customers, has significantly transformed revenue recognition practices across various industries, with the real estate sector experiencing some of the most profound changes. Effective from January 1st, 2018, IFRS 15 replaces previous revenue standards and introduces a single, principle-based five-step model for recognizing revenue. In real estate, where contracts often involve complex terms, long construction periods, and various performance obligations, IFRS 15 demands a more detailed analysis of each transaction to determine when and how revenue should be recognized. Welcome to Chartered Accountant's Pen. This presentation is on the impact of IFRS 15 on the real estate sector. We will explore how this revenue recognition standard changes the way real estate companies record and report income from contracts with customers. IFRS 15, introduced in 2018, provides a single framework for recognizing revenue from contracts with customers, replacing earlier standards. It applies to all industries, including real estate, and uses a structured five-step model. The five-step model includes identifying the contract, pinpointing performance obligations, determining the transaction price, allocating it to obligations, and recognizing revenue when control is transferred to the customer. Real estate contracts often involve staged construction, long durations, and multiple deliverables. IFRS 15 requires a clear understanding of these elements to recognize revenue appropriately. IFRS 15 shifts focus to control transfer. Revenue is recognized only when the buyer gains control, not simply on payment or risk transfer. Services must also be separated and evaluated individually. Welcome to this example illustrating how IFRS 15 applies to a typical real estate transaction, the sale of an apartment unit. The sale price of the apartment unit is 10 million Pakistani rupees. An advance of 2 million is received at the beginning of the contract. Construction is expected to take 24 months. There is only one performance obligation, the delivery of the completed apartment. Revenue is recognized at a point in time, specifically when control is transferred to the buyer upon handover. Let's look at the journal entries. When the advance is received at contract inception, it is not recognized as revenue. Instead, the entry is debit bank 2 million rupees. Credit contract liability 2 million rupees. This reflects the company's obligation to deliver the apartment. As construction progresses and costs are incurred, say 3 million rupees in the first year, the entry is debit construction in progress for 3 million. Credit bank or payables. These costs are capitalized as assets until the unit is handed over. At the end of year 2, the apartment is handed over to the customer. Now, the company recognizes the full revenue. We reverse the contract liability and recognize the balance as a receivable. The journal entry is debit contract liability 2 million. Debit accounts receivable 8 million. Credit revenue 10 million rupees. Simultaneously, we move the construction cost to the income statement. Debit cost of sales 3 million. Credit construction in progress 3 million. Under IFRS 15, revenue is only recognized when control is transferred, not simply when construction is in progress. Advance payments remain liabilities until the company fulfills its performance obligation. This approach improves transparency and aligns revenue recognition with actual delivery. Let's walk through how revenue is recognized over time under IFRS 15 in a real estate scenario involving the construction of a customized villa. A customer contracts a real estate developer to build a customized villa on their own land. The total contract price is 12 million Pakistani rupees. An advance payment of 3 million is received at contract inception. The construction will take 12 months. There is one performance obligation, the complete construction of a villa. Revenue will be recognized over time because the customer controls the asset as it's being built. Progress is measured using the cost-to-cost method. At this point, 40% of the construction is complete, with costs incurred totaling 4.8 million rupees. When the advance is received, it is not recorded as revenue. Instead, it is a contract liability, as the developer has not yet fulfilled the obligation. The journal entry is Debit Bank, 3 million rupees. Credit Contract Liability, 3 million rupees. As work progresses and costs are incurred, 4.8 million rupees in this case. The entry is Debit Construction in Progress, 4.8 million. Credit Bank or Payables, 4.8 million. This records the capitalized construction work to date. Now, revenue must be recognized to match the 40% completion. 40% of the total contract price equals 4.8 million rupees. We reverse the contract liability up to the advance amount of 3 million. The remaining 1.8 million is recognized as an accounts receivable. The entry is Debit Contract Liability, 3 million. Debit Accounts Receivable, 1.8 million. Credit Revenue, 4.8 million. Then, we recognize the cost of sales. Debit Cost of Sales, 4.8 million. Credit Construction in Progress, 4.8 million. Because the customer owns and controls the villa throughout construction, IFRS 15 requires revenue recognition over time. This approach better matches revenue and costs with the actual progress of construction. The contract liability is gradually reduced, and receivables are recognized as performance obligations are met. In conclusion, IFRS 15 has a transformative impact on revenue recognition in real estate. Success depends on deep contract analysis, updated systems, and effective internal controls. Thank you for watching. For more accounting insights, subscribe to Chartered Accountant's Pen.